Over 40 years of absolute warfare on the trading floor, through the devastating panic of 1907, the wild, intoxicating bull runs of the 20s, and the historic 1929 crash that broke the back of Wall Street, I discovered a dark secret about this tool. It is a secret that the modern retail crowd has completely forgotten. What I am about to share with you in this video cost me 3 entire fortunes to learn. I had to pay the ultimate price to uncover this reality. You are getting this exact same multi-million-dollar education today, right now, for free. So do not look away. Do not skip a single second. Because the illusion we are about to shatter in the next 2 minutes is the exact reason your account is shrinking, and everyone around you is making the exact same mistake. Step into any modern trading community, look at any forum, or watch any standard tutorial, and you will hear the exact same mechanical sermon repeated like a religious prayer. They tell you to plot a 50-period line. They tell you to plot a 200-period line. And then, they tell you to sit and wait for the ultimate holy grail, the golden cross. When the fast line crosses above the slow line, they tell you to buy with absolute confidence. When it crosses back down, they call it a death cross, and they tell you to sell. This isn't a trading strategy. It is a mathematical confession of ignorance. The traditional crossover system, used the way 99% of amateurs use it, is nothing more than a lagging ghost. It forces you to deploy your capital into a trend that has already matured, usually right at the exact moment the smart money is getting ready to reverse the market. It turns you into a reactive gambler, chasing shadows on a screen, while market ruthlessly shreds your account to pieces inside sideways consolidation zones. The fundamental flaw of the amateur operator is a deep, psychological obsession with absolute certainty. They treat the market like a riddle that can be solved with a secret geometric key. The moment they discover technical indicators, a wave of relief washes over them. They look at a historical chart, adjust the settings until a line perfectly matches a couple of past turning points, and their ego tells them they have cracked the code. They feel a completely false sense of control. But the market does not care about your need for control. The market has never cared. The massive institutional desks, the central banks, and the multi-billion-dollar algorithmic funds that actually dictate price movement do not look at retail indicators. They do not care if a stock has touched a 50-period average on a 15-minute chart. They operate entirely on deep liquidity, systemic value, and hidden execution models designed to mask their footprints. When you buy an asset simply because it touched a line on your screen, you are playing a game of pure hope. You are praying that some giant financial entity will suddenly show up at your exact price coordinate to carry the weight for you. That is not speculation, it is financial suicide. Think about the raw reality of a golden cross. For a 50-day average to mathematically cross above a 200-day average, the underlying price must have already been screaming upward for weeks, if not months. By the time that signal finally prints on your daily chart, the meat of the move is completely gone. The professionals who accumulated their positions at the absolute bottom when the news was terrifying, and the public was in a panic now looking for a massive pool of liquidity so they can exit their positions. And who provides that liquidity? The textbook retail trader who just got his glowing confirmation signal. You are literally standing at the top of the mountain, handing your hard-earned cash to Wall Street's elite so they can safely exit the market. Real markets move in massive, sweeping trends for one reason, and one reason only. Because the collective weight of institutional capital pushes the price along the line of least resistance. During my entire career, I didn't care about corporate propaganda, political forecasts, or the endless rumors whispered in Manhattan restaurants. I cared about one thing: discovering the path of least resistance and ensuring my capital was aligned with it. Everything else is a distraction, and this is the exact secret that 99% of traders will never understand. The moving average is not a signal generator. It is not a magic wall. It is not a predictor of reversals. It is a structural compass designed to show you the raw vector of institutional momentum. If the slope of that average is pointing clearly toward the sky, it is telling you that the consensus value of the market is rising day after day. The path of least resistance is up. If the slope is pointing toward the floor, the path of least resistance is down. And if that line is flat, wandering horizontally like a ship without a rudder, there is no path. There is only toxic, high-friction noise, and a master speculator does not risk capital in noise. The professional operator looks at the slope and asks a structural question. Is my money moving with the dominant tide, or am I trying to swim against an ocean current? We do not care about minor daily fluctuations. We do not care if the price dips slightly below the line during a volatile morning session. We analyze the trajectory of the slope. That angle is the undeniable footprint of the smart money accumulation. Your only job as a trader is to find that slope, place your capital in direct alignment with its direction, and possess the rare, freezing discipline to sit perfectly still until the slope itself proves the environment has changed. To turn this secret into a weapon, you must look at every chart and instantly filter it into 3 unbreakable environments. In the first environment, the moving average possesses a clear, undeniable upward trajectory, and the price bars are trading cleanly above it. In this phase, your operational mandate is absolute. You are either a buyer or a passive observer. You do not short sell. You do not look for bearish narratives. You do not listen to media gurus screaming that the market is a bubble. The slope is your commander. As long as it points toward the upper right corner of your monitor, you maintain a long bias, or you sit completely in cash. Why? Because the structural flow of billions of dollars is at your back, even if your entry timing is slightly imperfect. The heavy tide of institutional accumulation will actively work to lift your trade back into green. Trying to short sell in this environment is pure arrogance. You are trying to stand in front of an express train because you think you are smart enough to guess the exact millimeter where it will stop. In the second environment, the moving average features a distinct, heavy downward slope, and the price action is trapped beneath it. Here, the law flips completely. You are a short seller or a cash protector. You do not buy the dip. You do not try to catch the falling knife, because an asset has dropped 60% and looks cheap. During the structural unwinding of 1929, I watched some of the most intelligent men on Wall Street get completely wiped out because they broke this single rule. They looked at premium corporate giants that had fallen from $150 to $80 and treated it like a retail discount. They bought with heavy leverage, only to watch the unyielding line of least resistance drag that stock down to $40, then $20, and straight into total bankruptcy. An asset is never too high to buy if the path of least resistance is up, and it is never too low to short if the path is down. In the third environment, the moving average loses all trajectory and flattens out completely. The price whips back and forth across the line erratically, closing above it one day and crashing below it the next. There is no line of least resistance. There is only chaos. In this zone, the professional speculator executes the hardest and most profitable trade in the entire world. Absolute inactivity. They close the platform. They step away. The amateur, driven by a dopamine addiction, tries to force trades in this meat grinder. They buy a minor breakout, get stopped out, flip to a short, and get stopped out again. By the time the market finally decides to trend, their account is already dead from 1,000 tiny cuts. The biggest losses in. Speculation do not occur during roaring bear markets. They occur when undisciplined traders try to force a trend in a sideways market. So, what is the secret setting? Retail gurus make this look incredibly complex so they can sell you indicators and courses. Let me give you the unvarnished truth. The exact mathematical number does not matter nearly as much as you think. Whether you use a 50, a 100, or a 200 period line on a daily chart, they will all tell you the exact same macro story. If the market is trapped in a systemic decline, all of those lines will be pointing at the floor. The hunt for a perfect mathematical number is an amateur illusion. However, to completely eliminate the daily chatter of the tape and filter out the temporary panic spikes of the retail crowd, I recommend one specific configuration: the 100-period exponential moving average applied strictly to the daily chart. We utilize the exponential moving average because it applies a slight mathematical weight to the recent price action, keeping you sensitive to real structural shifts while smoothing out the minor daily chaos. But remember this ironclad law. You use this 100 EMA for one solitary purpose: to determine the current trajectory of the line of least resistance. It is a macro compass, never an entry trigger. To extract consistent fortunes from this system, you must subject your trading behavior to 4 commandments of execution. Commandment number 1. The directional slope of the 100 EMA is a hard, legal boundary line. If the line slopes up, shorting is legally forbidden. If the line slopes down, buying is legally forbidden. There is zero room for negotiation. Commandment number 2. The moving average line is an analytical filter. It is absolutely never an entry trigger. The amateur sees the price pull back to the line and buys blindly out of excitement. The line simply gives you strategic permission to prepare for a trade. It does not give you permission to pull the trigger. Commandment number 3. Your actual tactical trigger must come entirely from raw price action at the pivotal point. A pivotal point is a clear, horizontal level where the market previously demonstrated an absolute exhaustion of momentum, the most recent significant swing high in an uptrend. You do not buy the pullback. You do not guess where the bottom of the correction is. You wait until the price finishes its consolidation, turns back around, and explodes through that previous peak on a strong, decisive daily close. The average gives you the strategy. The pivotal point gives you the execution. Commandment number 4. Once you enter at the pivotal point breakout, your exit strategy belongs entirely to the moving average framework. As long as the price action stays on the correct side of the 100 EMA and the slope remains firmly in your favor, you are required to hold the position. You do not take quick, small profits because you are scared of losing them. You exit when, and only when, the market issues an explicit structural command, meaning the price closes decisively on the wrong side of the 100 EMA, or the slope itself rolls over against you. Let's visualize the exact life cycle of a professional trade within this system. Imagine a high-quality asset. The daily 100 EMA has been sloping cleanly upward for several weeks. The price moves in natural waves, reflecting the breathing rhythm of capital flow. It surges upward aggressively, driven by intense institutional demand, until it reaches an exhaustion peak at exactly $100. At this specific coordinate, profit takers step in, the momentum stalls, and a healthy technical correction begins. The price drifts down to $92, then down to $88, moving closer to the rising 100 EMA line. The amateur trader is panicking, watching his screen, or trying to play the hero by guessing the exact bottom. He is losing money on every tick. The professional speculator sits perfectly still, acting with absolute calmness. He does not buy at $92. He does not buy at $88. He takes his charting tool and draws a bold horizontal line across the absolute peak at $100. That line is the pivotal point, the ultimate line in the sand. We let the market breathe. Eventually, the selling pressure dries up. The long-term line of least resistance takes over, and the price begins to climb again. $94, $97. We do not enter yet. We do not anticipate. The price could easily form a double top and crash into a bear market. We demand proof. Before we risk a single dollar of our wealth, we wait until the price approaches the $100 boundary and explodes through it, closing the daily session at $102.50. The moment that daily candle closes cleanly above the pivotal point, the structural environment has completely changed. The market has just provided undeniable proof that the buyers have completely absorbed every single piece of available supply at that level. The short sellers are trapped. The line of least resistance has violently reasserted itself. You execute your buy order at the close. You place your catastrophic stop-loss safely below the lowest point of the recent correction at $88. You paid a premium to enter at $102.50, but that premium is your insurance policy. You let the market prove its intent with its own money first, and only then did you deploy yours. You now possess the entire secret blueprint. It is a beautiful, flawless piece of financial architecture. Yet, despite having this pristine system handed to you right now, the vast majority of people listening to these words will still fail. They will still lose money. Why? Because the system is completely helpless against the biological flaws of the human brain. The rules are remarkably easy. The man sitting in the chair is the problem. When you are staring at a live chart and the breakout happens, your ego will lock your finger with fear. It will whisper, what if it's a bull trap? What if the economic data tomorrow causes a crash? What if you are the last fool buying the top? You succumb to the fear. You hesitate. The next morning, the asset gapping up violently, surging another 5%. You are left frozen, watching a legendary trend leave you behind, filled with bitterness. Or you conquer your fear and enter the trade. It moves in your favor, reaching $110. You feel invincible. Then, the market takes a natural breath and enters a minor pullback, dropping to $104. Your open profits shrink. Instantly, primitive panic takes over your nervous system. Your brain screams to protect what's left. You close the position for a tiny gain. 2 days later, the minor correction ends, the asset catches the massive institutional wave, and launches into an uninterrupted, 400% historic bull run. You are left standing on the sidelines, completely hollowed out by regret, because you could not sit still. This is the eternal psychological war you must fight every single hour of your career. It is never a war against the market. The market is an indifferent arena of capital. It doesn't know who you are. It doesn't care what price you entered at, and it has no malice toward your well-being. The war is entirely against yourself, against your greed, your fear, and your utter inability to maintain complete physical inactivity while a professional position works out its macro destiny over several months of natural volatility. You must view a hit stop loss not as a failure, but as a standard cost of doing business, the exact same way a store owner views monthly rent. Until you detach your ego from the daily fluctuations of the tape, you will remain a permanent member of the losing crowd. Let's cement this entire methodology by walking through one final mental case study. Visualize an asset where the 100 EMA has been completely flat for 5 consecutive months. The price action is a violent, choppy mess. The headlines are a disaster of contradiction. Your operational command? Absolute inactivity. You watch the amateur. Crowd destroy their capital inside that meat grinder while you protect your mental energy and your wealth. You recognize that a flat line means equilibrium, and equilibrium contains no profit. Suddenly, a massive structural shift occurs. Intense institutional volume enters the tape. The price shoots up, and the 100 EMA tilts upward, pointing distinctly toward the sky. The path of least resistance has officially spoken. The asset finally hits a temporary ceiling at exactly $60 and enters a healthy correction, dropping back down to $50 near the rising line. You maintain absolute discipline. You take your tool and draw a crisp, horizontal line across the absolute exhaustion peak at $60, your pivotal point. The trend reasserts itself. The price turns around and explodes through the $60 barrier on massive volume, closing the daily candle at $62. You execute your long position instantly at the close. Your stop loss is set at $50. Weeks later, a negative macro headline hits the news. The asset drops down to $54, putting your position into a temporary open loss. The crowd panic sells around you, but you look at your daily chart with cold objectivity. The 100 EMA is still sloping beautifully upward. The price has not closed below it. The market has not issued an official command to exit. You ignore the noise, you ignore the news, and you execute the hardest trade in the world. You do absolutely nothing. Your discipline is rewarded. The panic ends. The sellers are absorbed. And the asset launches into a massive 10-month bull market, roaring all the way to $180. The 100 EMA follows the price the entire way up like a protective shield. You do not take early profits. You let the trend compound your wealth month after month. Finally, nearly a year later, the market hits a heavy distribution wall, crashes decisively below the 100 EMA at $130, and the slope of the line rolls over. The trend is dead. You close the position instantly, locking in a massive fortune. Number arguments, no prayers, no hope. You step away from your desk and prepare to wait with supreme patience for the next clear structural trend to manifest on the tape. The market does not pay you for being clever, nor does it pay you for working hard. It pays you for one thing and one thing only, for having the rare structural alignment to get on the right side of the line of least resistance, and for having the absolute psychological fortitude to stay there until the line itself changes. The moving average, stripped of retail fantasy and used strictly as a visual filter of macro trajectory, is the ultimate secret tool to keep you aligned with that reality. To turn this lesson into an active edge for your business, you must take 3 immediate actions before you close this screen. First, perform a chart audit. Strip away the indicator noise and apply a single 100 EMA to your daily charts. If you are long an asset where that line slopes down, manage your risk immediately. Second, practice the discipline of inactivity when the line goes flat. Third, write the 4 commandments on a physical card, place it directly above your desk, and read it every single morning before the market opens. Remind your ego that the slope is your master and patience is your only edge. The line of least resistance is active on the tape right now. Master your mind, align your capital, and let the financial markets pay you for the rest of your life. go to the description below this video to find links to the two books, Thinking Like Jesse Livermore and the Livermore Journal. Subscribe to the channel right now and watch the video that appears on your screen to master raw price action without any indicators at all. There are no shortcuts. There is only the path of least resistance, the patient mind, and the disciplined hand. The big money is never made in the buying or the selling, it is always made in the waiting. I will see you in the next video.